Welcome to today's webinar, courtesy of the Kentucky Small Business Development Center in Louisville. Discover no-cost, valuable business services to help you thrive, whether starting your entrepreneurial journey or scaling your existing business. We have the resources and expertise to help you succeed. For more information, please visit our website or text 502-977-5800. Thank you for joining us today. Feel free to use the chat feature to ask questions or engage with our speaker. Let's get started.
Hi, everybody. I'm Dave Etkin. I'm the director here at the Louisville Small Business Development Center. Welcome to another edition of our Toolkit Tuesday. We're really thrilled to have you here with us today. As always, I'm joined with my good friend, co-worker, and our communications director, Janet Flaw. Hello, Janet.
Good evening. Happy April Fool's Day.
That's right, it is. No jokes today, though, because we've got a no-jokey type of subject to talk about today. But just a little reminder, too, before I introduce our guest today, just want to reiterate a couple of things about the Kentucky SBDC. You know, we are a statewide program. We have tons of essential resources that you need, and best of all, everything we do for you is free. So please reach out to us, at KentuckySBDC.com, or you can call us at 1-888-475-7232. Quick housekeeping, just to make sure that you can see and hear us well. If you look at the bottom of your screen, you should be able to see a toolbar. If you don't put your cursor down there, it should pop right up. And there you'll find the chat feature. If you wouldn't mind just putting your name in there and saying hello. Tell us where you're joining from. That's my favorite thing to do, is to see where everybody's joining from. And we get people from all over the country, which is super interesting to me. So just pop in, give us your name, and tell us where you are, and let us know you're out there and still breathing. Hello, Stephen. Good to see you. Judy. Hi, Judy. Renetta. Hey, Renetta. All right, Killeen Turner from Corbin, Kentucky. All right. Corbin's a cool town. So, yeah, good to see everybody tonight. Hey, Diane. Elkton, Kentucky. Awesome. Awesome. Lexington, hi, Savannah. Lisa for Virginia. You're our travel buddy today. You got the distance award. Way to go. Keep up the good work. Thanks for finding us. I really do appreciate that. So as we go through our program today, if you have any questions or comments, just put them in the chat down there. We'll get to them. We have plenty of time for Q&A. And this is a real opportunity for you to talk to a real expert. So let's dive in and introduce our guest today. J.C. Phelps is also a business coach here at the Small Business Development Center. He's also our statewide training coordinator. Plus, he is actually going for his doctorate tomorrow. He's defending his thesis, so he took time off. He does a lot of teaching too, graduate students and undergrads at Cumberland University. Is that right?
Lindsay Wilson.
Yeah, Lindsay Wilson. I knew that. I knew that. You're getting your doctorate at Cumberland College.
That's right.
Okay, my mistake. Well, you are speaking tonight about a subject which is near and dear to my heart, because I love numbers and love finance, and I dig into that stuff every day. But you have a great way of presenting these, what can be a dry subject, and really learning the language of business, which is numbers, and learning how to make decisions, which is the most important thing. So JC, why don't you pop in here and share your screen and tell us what you have to show us what you have to show us today.
Let's do it. Let's see here. Okay, let's rock and roll. Hi, everyone. I am excited to be here. Profitability is no April Fool's, as Dave was saying, but it is a very, very important topic. And hopefully we can look at profitability in a very warm, welcoming way, casual way, but a way that's impactful. I think that's how you get numbers to speak to you. You have casual conversation with them. Dave was mentioning we're statewide. Here's a nice little graphic for you. We do have service centers that go all around the state. We certainly work together as a network, but we have people that are strategically placed here at the SBDC. And so we would be happy to help you with financial projections if you're trying to do those for your business or whatever you may need. That is what we are here for. Okay. But let's get into, oh, that's not the good stuff. I'm JC. It's good to meet you. And as Dave said, I hope this is the last day that MBA is past my name because I'm defending my PhD tomorrow. Hallelujah. But all of that to say, the really exciting part is not me, it's profits. And there are a few things that excite me more than profits. And so, what I'm going to be presenting to you today is the practical side of understanding profits, understanding a profit and loss statement, thinking about how we can optimize our business processes that can lead to a difference on the bottom line. And I feel like, looking at it this way is very much in tune with small business. This is less sophisticated, if you will, than if you're looking at a 10K report of a very large business, but these strategies work and they're tried and true no matter the size. And so I'm excited to chat. What are we going to accomplish tonight together? I want you to understand structure and purpose. There is no quiz, I promise, of a P&L statement, right? You cannot understand the profit of your business if you do not understand the profit and loss statement, which we often call more formally the income statement, but you'll hear me call it a P&L all night. What I want to do is look at a very simplified P&L with you and identify areas that are truly high impact that you can change. And in each part of the P&L that we look at, I'm going to be giving you a practical tip. So hopefully that will help you where you can boost your profit. And then hopefully at the end, I'll provide some take-home tips that you can utilize that will reduce some costs that sometimes very much, easily get hidden, but hurt the bottom line. I want you to increase the lifetime value of your customer, a few strategies for that, and we'll talk about improving your cash flow without increasing debt. That's the important part there. I will say I'll forward these slides to Janet. Janet is awesome, as you all heard, and as many of you all know, and she tends to get out that material to you if you would like to look back at any of this. And so I appreciate you doing that, Janet. All of that to say, if you've been in a training with me before, I like a burden of proof. Yeah, I want to prove to you why what we're talking about is important. And financial statements, while you may find them boring, I find them very exciting. They matter in grand capacity. And it's because when we look at profit in specificity here, the P&L statement, profit is not just about making sales. That is a fallacy I want out the door right now. You can be more profitable than someone that sells 10 times what you do. Okay? It's not about that. It's about managing what you keep and what we start at the top line with. Okay. You cannot understand that if you cannot allocate your expenses and have an understanding of how we go from top to bottom. And so the financial statements, as exciting as they are, what they do is that I tend to look at them as opportunities. They are opportunities to do better and to streamline and to make our processes more efficient, but they also show risk, and it goes line by line, and that's why it's so critical. Practical tip here, we're already starting. This is maybe a harsh way of saying it, but I'm going to say it. This is business pet peeve number one for me. It mind boggles me at times when people are in business that don't take time to look at their financials. Financials are not things that you should be looking at come tax time. And you're looking at all your expenses. This is something I think you should do far more than every month, but I'm all for building strategies that you can, internalize and make habit. But, have 30 minutes, have an hour each month, review those months, that month's financials, your P&L, your expenses, what came in. These are things you need to be doing both in a casual way, but casual can still be sophisticated. I'm a firm believer in that. That's going to help you maintain budget, maintain goals, see where you stand, while also not waiting too long, if you will. I'm not a science person. Thinking about taking science classes again is not fun. But let's talk about the anatomy of a profit and loss statement. Let's put it into everyday terms, things that we all can conceptualize. If we look at a P&L at its core, a P&L is what you earned, aka what you brought in, right? What it cost you and what you spent. Easy enough, right? Make that a positive number and we have a profit. If only it were that easy. But profit and loss statements have many different focus areas, and so sections of the body, if you will. And we tend to look at those and manage gross profit trends. What's happening to that gross profit? What's happening in our expense categories? What's eating into the bottom line? And I think the example I'm going to go through tonight shows that in a very realistic, but also very clear capacity. Tip, here we go again. You need to have a P&L, right? A P&L is far beyond than, just having something on a legal pad. I'm the king of the legal pad, so I'm calling myself out. Maybe it's something you have in Excel. Maybe use a software like Wave. Maybe use QuickBooks. I taught a training actually not too long ago with the Louisville SBDC about affordable accounting softwares. But all of that to say, there are free templates, there are free to low cost options. You need to have something there. And also, in thinking about working with your tax professional, something that you need to keep in mind, because the straighter the books are, the easier the job for the tax professional, which tends to lead to less billable hours if you're trying to save yourself out of a mess. Before we start, I do want to say finance and accounting are not the same thing. I do teach finance on the collegiate level. I love finance. But I'm not an accountant, and this is not accounting advice. At the SBDC, we provide business coaching services. Even if the degree is there, we don't act on your behalf as attorneys, as accountants, etc. But here's the case study that we're going to go through, and I want to take a couple seconds and walk us through. But you're going to see this graphic a lot. Okay, this is what I want to tell you. This income statement is grossly simplified. And by income statement, I mean profit and loss. It is grossly simplified. It's a very short one, okay? I like ones that are in great detail. Um, but all of that to say, I have to be considerate of what I can show you here on a PowerPoint screen. You don't have, a pamphlet in front of you. I'm not teaching you. I'm not with you in person. And so it still gets the job done, okay? When I first start teaching P&Ls to undergraduate business students, this is the one I use actually, and then we go further. But my students get so sick of hearing about Clear Lake Sporting Goods. Clear Lake Sporting Goods does not exist. We're going to be looking here at a fictional business, and we have 2 years of data, year-over-year data, which is always great for comparison. And it helps us here identify some clear trends, and we're going to talk about the trends in this data itself. Many people say, I want to grow my business or I need to sell more. Sure, growth is great, but only if it's profitable. It's not always profitable. And yes, there can sometimes be short-term loss for long-term gain. That's a big assumption here, and I understand that. But generally speaking, management takes you a long way. Year over year, quarter over quarter, this is how we are advantageous with our analysis. You can look at a single year all you want, but if you can't compare it, how do you see trends? How do you see what's changing? So again, you're not going to be making a P&L for me here, but I want to talk to you about what is a P&L, a profit and loss statement. We're starting with gross sales, okay? This is how much your business sells, what you're starting with. We have returns and allowances in this capacity, meaning, they have returned some merchandise or goods, which led us to net sales. Okay. Out of net sales, and we'll talk more about each of these sections. So, don't stress that I'm going quick. We have cost of goods sold. Okay. That's a biggie. We're going to dissect that bad boy. That leads us to gross profit. Okay. We have many operating expenses that then come out. For this very simple form, there are only four. Okay. There are, of course, many operating expenses. And you could break down your COGS section certainly into many line items. But here we have rent, depreciation, salaries, utility. And when you take out operating expenses, to no surprise, we're left with operating income. Okay. Operating income looks at the income before interest and financing expense. And so we have some interest coming out here, meaning there's a business loan, tax expense, and then we're left with a net income. Okay. So, what you often hear someone say when they talk about business or they talk about their books, like, oh, yeah, the business did really great last year. It did 126,000. If say we're looking at current year here, what that person's probably not telling you is the net income, the bottom line there is 35,000. Yes. And the really scary part for me in just thinking about um, you all and wanting you all to do well and any small business to do well is that sometimes people don't understand how we went from 126 to 35. That's one of the main points. And then ideally, yes, the 126, it'd be nice to get that higher. It'd be nice to get that 120 higher there in your net sales. However, if what happens between 120 and the net income line also gets bigger, your profitability is not going to change. And so that's something that I want to make clear. If you're calculating your profit margin, if you were to do that, a very common financial metric, you're of course going to take this income and divide it by your net sales there. So let's talk about net sales. I'm on line item 3 here. Okay. I certainly care about gross sales, and I certainly care about managing sales and returns for sure. That detracts. But, net sales, things that weren't brought back, this is where we are. And so if I look in prior year here, you have sold $100,000, in current year, 120. So you could say net sales grew 20%. That's fantastic. But I ask you the question, are those extra sales profitable? And I would argue no, right? If we take the net income of our prior year, where we sold 100,000 in net sales and we had 30,000 in net income, that's a 30% profit margin. But with a net income of 35,000, I'm right here at the bottom. If I correlate that to my 120,000 of net sales here, that's a 29.16% profit margin. AKA, yes, my sales grew by 20%, but my profit margin fell by almost a percent. Okay, I care about that. There are tips, and we'll talk about many of these. But yes, you can think about increasing your revenue, and that's a great, way to do it. But we're going to talk about maybe potentials of upselling or bundling or smart discounting, not, discounting maybe due to poor inventory management. That's upcoming. But we want this number to be big in line 3, certainly, but we want that profit to correlate. And in this case, in the case of Clear Lake Sporting Goods, that did not happen. And we'll start, subtracting line by line. Why did that not happen? Let's look at gross profit. Gross profit and cost of goods sold here. This is where things quickly get out of hand for small businesses. One of the main reasons, or one of the main ways. Gross profit is after we subtract out those COGS. Okay, so the cost of goods sold here, I want you to keep a very strong eye on that. Rising material costs, aka dealing with inflation, that's obviously going to hurt. I understand that things are more expensive, and I understand you can't outprice your client. That's true. But if you do not pace with inflation in your expense, if you're able to, your profit is going to decrease because you're going to be making less per unit. Your marginal cost is higher in that case. Maybe it's labor costs that you have. That is going to significantly eat down into it, even after gross profit, and thinking about whether you classify that as operation or not. So, what things can you do? You can shop your suppliers. Can you get things cheaper? Sometimes we get really comfortable with the familiar, and that can be an error. Can you get it for cheaper? By all means, do, because little savings do very much add up. So I want you to look here. I did sell more, but my cost of goods sold did go up by $10,000. Maybe that could be justified because I bought more inventory, which made me sell more. That's indeterminable from what we have here. But you have to understand what it is you are spending to get that item on the floor, hypothetically speaking. And many people forget the expenses that go into that. Okay. And so, what made it go from 50 to 60? And what are cost of goods sold? Many things. Do you buy raw materials, right? Fabric, metal, wood, your restaurant ingredients? Okay, that's a biggie, of course. Your inventory expense, that's a cost of selling the good, is buying the good, right? Maybe it's inventory, maybe it's something that, has a resale if you're buying wholesale, whatever it may be. Maybe it's packaging. Boy, those things can add up. Boxes, labels, the bags that you use, freight in, getting your stuff shipped to you, your raw materials, your inventory. Are you just really being eaten alive by shipping fees? That significantly adds to the cost of that good. That inventory purchase could be the same price, but if your shipping went up by $300, our cost of goods sold have just gone up. Maybe you have to pay for storage or warehousing. Maybe there are tools or equipment that you need to use in production. Maybe you have to maintenance the things that you have. All of these things are expenses that, in effect, are costs to get the good in the hands of the consumer. It's very easy for these things to creep up. And that's why you need a far more detailed, statement than this, what comes into that cost of goods sold. And you need to be looking, wow, these boxes, my shipping is way more. Can your item fit in a smaller box, right? Is it weight? Is it something that you're adding, etc.? Is there a different supplier that you can use? Can you order in a different quantity that will decrease, the amount of times you have to pay that shipping fee, etc.? This is how you lower your cost of goods sold. But if you just swipe your card or enter in your card left and right, you really don't realize how these things add up. Let's talk about expense management. Our expenses also go up. So the operational expenses, as classified in this statement, we have a rent expense, we have depreciation expense, we have salary expense, and we have utilities. Rent went up from 5,000 to 5,500. Did you move? If not, did they just raise it on you? And if so, did you try to renegotiate, right? Have you been a good renter? Maybe you can wiggle that down. Maybe they'll still go up, but maybe they're not going to go up $500 or $1,000. That's a really quick way to increase your profitability. That's overhead that you're going to be seeing in operations. Depreciation expense, I have a slide on that, but depreciation expense went up by $1,100. Assuming that you're doing straight line depreciation, that means that you made an investment of some sort. And so I'll leave that to the slide that I have that. Your salaries almost doubled. They went from 3,000 to 5,400. I didn't see my sales double. And I'm not saying that those go one and one. I'm not saying that. However, something to consider, okay? If it went by the same proportion, 3,000 to 5,400, and then I think about the 100,000 the way it was, let's see, times 100, I'm doing quick math for you all, divided by 3,000. I would have expected my net sales to go up to 180,000. They only went to 120. And so that increase in labor, I'm not so sure is fully justified. Something to easily watch, right? Are having those employees, having that labor, is it contributing to your bottom line or is it taking away? Sometimes the answer is not to hire more. It may be to hire smarter, but not more. Something to consider. Maybe you have, great big machinery, depending on what you have. turning it off, finding ways to reduce utilities. This might be a huge expense for some of you. I'm not sure of your business model. That absolutely makes a difference. Those small things add up. That renegotiation, better hiring, utilities. We may be talking about, a 4-digit number already here just on this very small business and this very simplified P&L. Okay. So we need expenses to be really spelled out. I want you to track every feasible expense. You need to have a line item, for a penny, maybe not. It can be in something else, but having really overarching categories can be dangerous because you can't see the little things that are affecting it, okay, depending on the need. Let's understand depreciation. Something that people often say or that you see, depreciation is an expense here. I'm not planning to turn this into an accounting lesson or a formal finance lesson, but depreciation is an expense that you can tie to a tangible asset. And the most common way to depreciate is straight line depreciation. However, assuming straight line depreciation, meaning, 2,000 a year, if you have 10,000 to depreciate for 5 years, my depreciation, which is highlighted in green here, it went up by 1,100. That means I'm presumably depreciating more things. And so I say here, new investment, we don't really know. But what I want you to think about is this. If you're going to buy something, if you're going to buy a tangible asset for your business, you need to be able to very clearly answer the question, did that investment lead to more profit and good, true revenue generation? And if it's not going to, if it's a vanity purchase, something like that, if profitability is the issue at hand, it's not a good buy. Any asset you buy should affect that net sales at the end of the day by my standard. And so that's what you need to have. This next line reminds me of the TV show Schitt's Creek, if you all have watched that, but this is something I hear very, very often. I think people justify expenditures for their business at times because they say, oh, I can write it off. It's a write off. It's a write off. Okay. Sure. I want you to write off every penny that is legal and is ethical. By all means. That helps take down your taxable income, and you need to account for that. But buying things because they are a write-off, and I see it all the time, that is not a good idea. I think I got a giggle, maybe a Schitt's Creek fan in the audience. But all of that to say, those are expenses that are coming out. That's cash flow that is leaving you. And so it's a really dangerous philosophy to be in. And it's a really easy way to get that net income level looking way smaller. Okay. And at the end of the day, ask yourself, is this needed? Does it add to the bottom line? If you can't justify the benefit of that purchase with the cost, please don't make it. That's just an average cost benefit analysis, but very dangerous philosophy that I wanted to bring up. So we are at operating income, okay? Operating income after we've subtracted out, we've had our returns to net sales, we've had our COGS, which lead to gross profit. We've had those 4 operating expenses. Now we're at operating income, which is, you can see here, from 38,000 to 43,000. This is your profit from operations before the financing and taxes. This is a really, really good number to focus on, okay? I'm not going to go into the EBITDA and a few things like that in this training, but it's a really, really great number to focus on. And the reason I say that, I want you to focus on growing your operating income, not people often think sales. I want you to think operating income, because if your operating income increases, we are being efficient. Okay. We're being efficient because we're managing the expenses that are taking me from my gross profit and my net sales, rather, from my net sales down to my operating income. That's efficiency, not more sales. Do both, and now we're really talking, and profit's going to look a lot better. But sales are not the answer. If you have another problem or diagnosis to make, okay? So Some actionable profit strategies. These are some small things that really add up. Okay. I want you to audit the things that you're paying for. And I will tell you, I'm not trying to sit here on a golden financial throne. I would like to think I'm good at finance, but I make mistakes in a lot of them. And one thing I like is a subscription. Let me tell you, I really do. In my personal life and business too, I like to try things. Audit those. That's a really fast way to eat at that money, and boy, those add up. Absolutely. I can tell you I have hundreds of dollars of subscriptions between my business and my personal each and every month. And wow, 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 does that add up? Cut it if you're not using it. If you don't get that value out of it, cut. Maybe you could look at sales strategies to go beyond, this training. But sales strategies, marketing and finance work hand in hand. Think about, can you bundle something? Can you bundle products or a service to increase the average order value? If that's the case, chances are you're expending less labor dollar for dollar to get there, and that's going to be a more efficient sale for you. So think about what you sell to the customer, right? If you have a restaurant and I can upsell you, or I can sell you an appetizer, I can sell you a couple cocktails, I have less labor expense in that than do you coming in for a second time and having a new day, new staff, etc. Discounts, I'm going to talk about this. Offer discounts. Here I am talking about discounting, but making your business more profitable. Hear me out. You can offer discounts for full or upfront payments. This can improve cash flow. This does depend on a cost benefit analysis, and there's some caveats there, but I'm going to talk about that soon. And then again, check your vendors, check your suppliers, threaten your business with them if they don't improve the rate, right? There's a common joke you can call and negotiate your Wi-Fi bill. Why aren't you doing that with your inventory and with your raw materials and your goods? If it's possible, it doesn't hurt to ask, right? Profitability of smart discounts. Here's what I actually mean by that. Some discounting can take away from profitability. But as you think about discounting, it is maybe a result of poor inventory management. Now, if everyone paid upfront, which they're not going to, by the way, or in full, of course, we're going to be bringing in less. But there's something, have you ever wondered why someone has offered you a discount to pay upfront? There are reasons, and there are great cash flow reasons. It improves your cash flow immediately. You're getting that cash in the business right now, which might be worth a small, reasonable discount to you. Okay. Money's in the pocket, which means you can reinvest it sooner. Maybe it's in inventory. Maybe it's in marketing. Maybe it's something in operations, not to waste it, but you have it. Those things can help grow revenue. Maybe you needed money to get more on the floor to make more sales. Great. Maybe that marketing campaign is going to lead to more sales. Great. And hopefully you're managing it right to mean more profit. Um, but it also reduces financing need. That's a big one. If you can avoid the need for loans, for lines of credit, for accessing financing for your operations, you're going to have better, you can do that through better cash flow. You're going to save interest, right? Going back to the forum, that interest expense is going to be lower. The lower that is, the higher the net income is going to be because that's subtracted out. That's a big reason to get cash flow and to focus on your cash flow, saving money in the long run. There is always a risk of non-payment. We have to think about that. Conducting business is a risk. The longer you wait on a payment, you have the risk of clients not paying. And they're paying, or paying late, maybe not at all. Upfront payment is a secured sale. And even going back to this, improving your cash flow, as we all know, things tend to get more expensive. And so if you can invest and get something that you need earlier on, you may miss a price hike. That's something to also think about. Administrative overhead. If you pay once, we good, right? Send an invoice, send a receipt, that's great. But if I'm trying to get, partial here, partial there, partial there, partial there, maybe you're paying an administrative person to do that. Maybe you're doing that. That adds to your expense. That salary expense could be less. You could have less billable hours. if you work smarter. Again, we're not talking huge discounts that's going to hurt profitability, but enough to incentivize someone while also helping you. Okay. Use that time more wisely. Instead of trying to track someone's money down, now you have that time to invest in your business in selling more or being strategic. Going back to some more general profit strategies, here's a really good one. Raise your prices strategically. And I'm not saying buy a lot. Don't alienate your customer. This is a topic I love, and I could talk about it for hours with you because I love teaching econ, and this is one of the things I teach in econ. But pricing is an art, okay? If something is best selling or your highest margin, boy, that's a good one to just creep up just a little because your customers are more inelastic, meaning they're going to want it. They have less responsiveness to price changes, called price elasticity of demand. That's a really good way to increase that margin. Again, you don't want to price them out. That's where, the money comes, is knowing where that threshold is. But it's not a bad place to look when you're first thinking about raising the price. Okay. If you look at your operational feasibility of your employees, you can optimize schedules, cross-train staff, reduce that labor overtime. In this case, labor in the second year took away 2,400 of profitability. That's significant. We can't ignore that. Inventory turnover. Inventory turnover is a financial ratio looking at your COGS divided by your average ending inventory. But in casual words, what inventory turnover is, it's how many times a year on average you sell your inventory. Improving how you manage your inventory is a huge part of profitability. You buy way too much of something, you're going to be putting a sales sticker on it. Putting a sales sticker is discounting, maybe not in the best way, and that item's going to add less to your bottom line. However, the cost of that item only goes up. You already had to pay for it, but it's taking space on your sales floor, right? Taking space from something else. That's opportunity costs. It's taking, effort in maybe trying to sell it on the floor, which could be labor, etc. We don't want to overstock. We don't want to pay storage costs. And some of these costs are intrinsic. And then I'm all for analyzing the customer and appealing to those that are high impact. Maybe you need to outsource. Dave and I have talked about this in my business before. Sometimes you need to do as you say. And I was really bad about not wanting to outsource, but I had to think about the average value of an hour of my labor, right? What is an hour of JC worth? And so there are things that I have begun to outsource that save me money, and I can invest that time in ways that help me make more money. Maybe in this case, in a micro case, it's saving you labor expense. By all means, we need to control labor costs. Let's quickly get out of hand. Again, I want you to monitor this bad boy monthly at minimum all the time. Look at the numbers, get in the numbers. It's only going to help you to set that goal. And then a profit strategy I want you to think about is marketing. The reason we have marketing, the point of marketing is to generate profit, right? I want you to track how you're spending that promotional dollar. And the reason I say that is if you're spending money on things that underperform or not providing a high ROI, cut it and put that money, invest in something that overperforms and in a way that's going to generate those profit and those revenue inducing activities. Okay. We can't do that without analysis. You may want to think about better inventory management. How are you going to manage your inventory? If you run low and you don't have cognizance of that, that tends to mean that we buy things at premium. Maybe it's rush shipping, maybe it's who knows what. There are many, many fees. Inventory management is a big, big part of profitability. I want you to look at your prices more than annually, but certainly annually. Look at cost changes, analyze your competitors, make sure you're not underselling yourself. There are two ways to increase profitability, said very easily. One, increase your revenues, or two, cut costs. Ideally, we would try to do both. Easier said than done. And then at the end of the day, however simple, people don't do this. I want you to implement some level of business budgeting, but you got to stick with it, right? Easier said than done, I know. But the controlling of your discretionary spending, the controlling of your, it's a write-off spending, right? Sometimes those are fun expenditures. Those eat at your profit, and that can't be ignored. Profit does not happen by accident. You should not be looking at your P&L at the end of the year and be like, woo, I made a profit. The business did so well. You have to manage for that. And you should know where it is as to how it is becoming, right? What is altering it. And your decision should be based on these actual numbers. You should not be guessing what something cost. You should not be guessing what your cost of goods sold is. Many people do. I can nearly guarantee you that you will underestimate things. When you underestimate things, you underperform. When costs are underestimated, your pricing might be off. When pricing's off, revenue is less than you would want it to be. When costs are higher, your profit margin is going to be lower than you want it to be. These things go hand in hand. You cannot be over cognizant of your expense. And an income statement, a profit and loss, it's a roadmap. You need to look at this thing like a direction. Which way do I need to go? Where am I messing up? How do I do that, right? Profit is fuel. It's what makes businesses go, but you got to protect it because how quickly it can go. Again, by the roadmap, is my issue in cost of goods sold? Is it in operating expenses, right? Am I finance? Do you have a lot of financing and you have interest expense? These are things that matter, okay? And by the way, something I want you to think about too, of course, the interest rate is um, relatively high, if you will, and has not been lowered. But something to think about when you're considering those interest expenses that certainly eat away at that profit margin. If you ever have the ability to refinance and it makes sense in the long run to a lower interest rate, that is a profit consideration as well. And so any of those line items, anything that detracts, that's what I want you to focus on because that's how we keep that number at the top as large as possible down at the bottom. Okay. Let's see here.
Got tons of questions.
I love it. Let's see what we got.
Yeah. Let's see. Yeah, Diane, regarding inventory, any suggestions for manufacturers who are build to order and not build to stock?
That's a great question. And Dave, please hop in too. I think one thing I would recommend to you, Diane, when something is built to order is while yes, that alludes to some level of customization, being in the numbers, being in the data is still going to help you because you need to understand what things do you tend to use the most, what past orders have looked like, are there trends in that, and that can help you make better buys. Certainly, even though it's custom, there surely are some things that are consistent. If not, maybe that advice isn't good. But some level of customization of your processes, sure, I would think would have some consistency. And so while you're not building for stock inventory, there is still a level of that I would recommend.
Mhm. I think it's kind of inventory or industry specific too. Like in the publishing industry, there's a lot of outsourced companies that will build, will print and publish for you on demand. So I think it's kind of, I think if you look around, you might be able to find some alternatives. There's always somebody trying to innovate with just-in-time inventory.
I love the
Um,
next question.
Hey, Judy. Hey, Judy, we haven't spoken in a long time. I'm going to reach out and see how you're doing. Judy says, my husband and I have a flooring business. Our salary becomes tricky when jobs vary by size. Yes,
Wow, that's a toughie.
it is a toughie. Yeah.
This is my view, Dave, and add to it. My income in my self-employment, what I do in my business, boy, does it vary. It's great in April. I see April 1st and I think, hallelujah, it's Derby. Here comes the money, right? And Q1's not looking so hot. Here's what I do because this is my business as well, not flooring, but similar. I don't care what I make. or what the business brings in revenue, my salary remains unchanged. That's one of the things I would recommend to you. And boy, is it tempting. Come May, I'm ready to go to the beach. I've had a good Derby month. I would like to rock and roll, but no matter what it is, I keep a reasonable salary that I know is enough as to keep me up. And then the rest, if you have, extra money that you can deal with, there are interest earning opportunities. There are things that you can invest, take away from financing, things that you can use that for operational efficiency. But I tend to not vary my salary on the variance of my revenue.
Yeah,
Dave, what would you say to that?
that's a good, I think, businesses like people need to have an emergency fund.
Yes.
And that's one of the hardest things to start. And our good buddy Dave Ramsey says that's the first thing to do. So what I recommend doing, and I do this personally and it works out well, is just open up a money market account that's interest bearing and then automatically transfer some amount of money on a Wednesday, every Wednesday at noon, make that happen. Could be 50 bucks, 20 bucks, 200 bucks, whatever it is, but just make that happen and then never touch it. And just starting out with those small amounts, it's amazing how that will grow. Also, if you have good terms with your bank, I mean, a line of credit is a great shock absorber for those type of things too. So if you don't mind a little bit of financing, but especially in trades like you are, where you have a lot of expenses that go out maybe, and they're tied up for a little while. Having a line of credit to draw down on until you get your funds in that people owe you is another good way to kind of manage that cash.
Hmm.
As you know, sales cost money, so
Absolutely.
you gotta have the cash for it.
Businesses absolutely need emergency funds.
Yeah.
100%. People forget that.
Yep. 2 months. Try to get 2 months. That's the rule of thumb. My rule of thumb, anyway. So. Let's see. Cassandra says, need an app that talks to you when we're at the register. Yeah.
Put the card down.
Yeah.
Do
Both sides of the register.
yes.
Don't buy that, Dave.
Don't buy that, Dave, but to the customer, please buy that.
That's right.
Depends where you are. Just think, if you're making a purchase you don't need, imagine a
Yeah.
little JC on your shoulder saying, Cassandra, do you need
Yeah.
that? It's eating at your profit.
Steven says, would you guys be willing to look over a business plan and critique it? That's what we do all day long. All day long. I think I did 3 so far today. So just KentuckySBDC.com, pick a coach, introduce yourself. Any of us be happy to help you.
Absolutely.
Yeah. See here. Colleen says, these are great questions and great knowledge. Great things to put into practice. Thanks for saying that. Stephen's going to help Cassandra with her programming. So, yeah, good stuff.
I was still pinned. Sorry, Dave. You all,
There we
one
go.
thing you all don't need to see to increase your profitability is an enlarged JC. So start.
Diane, sorry to beat a dead horse. In manufacturing, we have long lead time from suppliers, leading to lots of inventory on hand. Yeah. Yeah, work in progress. Any good options to approach suppliers for longer payment terms? Yeah. I mean, that is, you know, the manufacturers may not grant the payment terms, but there are, that's when I think financing comes key, where you can get a line of credit, or, man, I hate to even recommend going down the road, but you can use a factor or a purchase order financing. It's a little bit expensive money, but that's where, you get an invoice. You can actually, in essence, sell the invoice to this factoring company, which is a financial institution. They won't give you the full amount. They'll give you some sort of discounted amount. Then they'll collect the money, but you get your money up front. But those discounts, those fees, the cost of money can be pretty expensive and kind of get you into a cash flow trap. So yeah, start with your suppliers and ask for that. But they probably are in the same boat as well. But Never hurts to ask.
Also, just an aside too on Diane. This is I think a question from Judy, but that those larger purchases, if you're having a large lead time and you're wanting to, you need that on hand because it's hard to get it on hand. If you make your expenses very consistent, even in terms of what you pay yourself, you do custom orders. So you said those cash reserves will be higher. And so again, you could access a line of credit or something, as Dave was saying, and or if you're very prudent as revenue comes in, you can also have the cash flow on hand because, it's hard to it's hard to reduce that burden. But the one way to reduce an expense burden is to have a positive cash flow to tie to it. Way easier said than done. Oh my heavens, I know, but um, that's a tough one for sure. The lead times are brutal.
Yeah, absolutely. Let's see. Oh, Diane says, or anything to reduce the cost of inventory on hand. And I don't know. Don't you contact one of us and let us dig in a little bit? And since you're a manufacturer, I don't know if you've talked to the Kentucky Association of Manufacturers. They've got some good resources. And then what's the other one, JC?
What do they do?
Sort of like the hands-on consulting manufacturing guys.
I'm not sure off the top of my
Drawing a
head.
blank. Well, I'll figure it out. Yeah. Sorry, I'm drawing a blank.
It happens.
It does.
There's only so much room for knowledge in there,
I
Jay.
know.
Have a lot. And the other thing, this is the marketer in me. I'm like hybrid numbers guy and marketer, Diane, but I'm also thinking there's inventory on hand. What's your sales funnel look like? One way to reduce that inventory on hand is to get another order coming in. And so, I tend to think of that in relation to the inventory turnover. I don't want a large, expensive inventory just hanging around if it's not there making me money. And so, while certainly there's a operation side to that, there's also a funnel side of that. As to, without knowing the business, it's hard to make a sweeping statement. But how do we turn that inventory into an order quicker? And that's more of a marketing operation. But my brain definitely goes there. They work hand in hand.
Yeah. 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 Yeah, that's an interesting question.
I
It
love it.
reminds me of that old book, The Goal by have you read that, JC? Elihu Goldthwait, I think was his name. I just
No, I'm not
saw that the
familiar.
other day. Yeah. Well, check it out. Diane just
Maybe now that,
The
assuming
Goal.
my PhD is over tomorrow, I can read for fun again. Yes. So maybe I'll read it this summer.
Yeah, check that book out. There's another great book too, Dan Heath, Reset is really good for manufacturers too. I would check that out. Yeah.
I would presume not, Diane. It certainly adds challenges.
Yeah.
Absolutely. Could have advantages and also made to order, there's tends to be a price premium at times with that too,
Yeah.
which can lead to some cash flow cushion in your pricing structure if you're, referencing a high level customization.
Yeah. Yeah. Well, contact one of us. We'd be happy to talk to you. Do whatever we can. That's what we want to do. That's what we're here for. That's what we enjoy. Well, JC, it looks like that's all the questions we have today. We're about at the top of the hour.
Everyone's counting their dollars, thinking of how they can
Right?
profits going through the roof.
Yes. So, well, JC, good luck tomorrow, and thank you so much for taking your time out this evening when you should be prepping up for the big day. So we really appreciate it. I know everybody else does too.
Thank you. Thank you. I've had fun. It's fun to talk about profit for 55 minutes.
Janet, thanks for being here with us and driving the ship as always.
Thanks, guys.
Yeah. Thanks everybody for joining us. I think we'll have a little survey at the end if you want to hang on for just a second when we click off here, and we really need that information. It's good good for us to hear from you. We always want to get better and hear what you have to say. So please take a minute to do that for us. JC, thank you. Janet, thank you, and we will see you guys on our next Toolkit Tuesday. Good evening, everyone.
Thank you kindly. Have a good evening.